Hello, MTI members. Michelle Kosas here, your economist with ITR Economics. Tom had reached out to me and let me know that some of you had some concerns about the oil and gas industry, and I certainly see where you're coming from. Oil prices have been relatively low, so while I'm recording this, they're in the upper 50s per barrel. Spent a lot of time in the mid to low 60s in recent months. So that is a concern paired with relatively sticky or higher interest rates. That's meaning that, fewer projects are getting started out there. So when we look at the drilling and exploration phase of the oil and gas industry, it is declining, but it is in phase A recovery. So the annual rate of change is negative, but it is moving upward. It's beginning to improve. However, still some headwinds there between the oil prices and interest rates. And then if we take another slice of the oil and gas supply chain, if we look at extraction, that's at record levels and it's in phase C, slowing growth. So depends on, the clients you're working with, kind of where are they along that oil and gas supply chain. When we're looking forward to 2026, the economy is set to improve. So that's going to support demand and prices for oil. Seeing some mild improvement, but this isn't a really strong growth coming. It's on the more mellow side. And given the kind of sticky interest rates paired with that, the rig count is going to improve, but that's more so going to be in the back half of 2026. So not right away, but in the back half of the year. And then that extraction phase already at record levels and will continue at record levels in 2026. So further growth there. We're going to circle back to this slide maybe at the end. This kind of categorizing some of the areas that I see, where are some bright spots for the industry, where are the struggles, and also some of the unknowns, which are a little more geopolitical in nature. But I'll show this through a series of a couple different slides here. So starting out with what our oil price outlook is, in blue, that is the 3-month moving average historical data for oil prices. And then in the little dots out here are our forecast. So you can see that moving up towards, it is going to improve, but the oil prices are reaching the upper 60s, kind of very low 70s dollars per barrel by the middle of 2026. So what this means is for existing wells, generally they're going to be profitable. So with this next slide, what I'm showing you here is a survey by the Dallas Federal Reserve to the energy market, and is showing kind of what do you need for a break even for existing wells. And you'll notice this range, $26 to $45 per barrel, is well below both the current oil prices and where we expect them by mid-year. The problem comes more with the new wells. So the break-even cost that they're estimating for the new wells ranges from $61 to $70 per barrel. So as you can see, when we have oil prices moving back towards, $70 per barrel in the middle of next year, that's some pretty thin potential margins here. So that is going to kind of put a damper on the interest in drilling in the next few quarters here. But we do expect, a little more improvement around the middle to back half of the year. Right now, though, the oil and gas industry is feeling a bit more pessimistic than ITR is. So, kind of a year out, they're expecting $64 per barrel. And then, even not even really all the way to 70 by 2 years out. So we think there's going to be a little bit more upside because we're looking at that broader macro picture and some of the coming acceleration. So we think that, they're going to adapt their expectations as prices evolve. So if the prices trend like we are expecting here at ITR, that would be reaching those milestones a little bit faster than they're expecting. So you could see their sentiment kind of turn around as the pricing data improves. But again, still that's pretty weak as far as the break-even numbers for some of the new wells. So just this slide here, what I want to illustrate is the kind of macroeconomic background demand for oil. So what we're showing is oil consumption in blue, and then GDP in green. So you can see that historically they have a pretty tight relationship there. So when the economy is accelerating, that's a good thing for oil. You know, people are consuming more oil, and in turn, that's also going to help support prices as well. So that's what we see coming here, a little bit acceleration coming in 2026 that will support the oil and gas demand. One of the other factors here is, kind of, I also mentioned that rig counts. We're looking at the annual average here in blue. So you can see over time, the rig count has moved quite a bit lower. And then these dashes out here are forecasts. You see, we have a little bit of rise built in here, but that's not a whole lot of, not very strong growth rates coming. This is just kind of a mild growth trend here. So when we're looking at this average rig count here, one of the factors a major factor has been the productivity of wells. So that's charted inverse in green here. So, as wells have become more productive, we have fewer rigs online. But what I want to also take away from this is that, there has been that technological trend driving this, but also there was a lot of overbuilding back here in the early 2010s, and that culminated in that, 2015 oil price weakness, and that was a really painful spot for both the oil and gas industry and the broader industrial sector too. But we haven't been investing in that sort of pace like we were back then. So we don't have, they've been a little bit more kind of conservative in their drilling. So I don't think we face the same degree of kind of glut that we did in that situation back here. So when we looking at another factor here, the existing inventories of crude oil, can see that they've kind of dropped quite a bit. The major drawdown here came from the Strategic Petroleum Reserve. So if we were to take that out, it wouldn't be as as big of a drop there. But as we start to refill that, if we were kind of trying to get back up to some inventory levels that were normal for the preceding 20 or so years, we would need to have a little bit more production in order to fill those inventories back up to what was historically more normal level. So exports are another major factor here. So the export market, you can see, for a long time we didn't do a whole lot of exporting, but starting around the mid 2010s, that export market picking up their kind of exponential growth. So this is, exports on the bottom here in red, and then production up here. So they're taking up, increasingly important amount of the market for our oil producers. So this chart is going to show essentially the same relationship. It's just oil exports as a share of U.S. production. So you can see kind of ramped up from almost nothing to now slightly above, and then right around 30% of our production going to exports. So to me, what this means is that the trade negotiations could really matter for the oil and gas market. So it depends on, do some other countries decide to buy a little bit more of our energy in order to, to improve their trade balance. So kind of a little bit of an unknown, depending on how all of those trade negotiations kind of how those wrap up in the next few quarters here. So overall, though, when we look at what countries we sell our oil to, can see, pretty good chunk of Europe here, also good chunk of Asia. And overall, our outlooks for these regions and countries are positive for 2026. So in this table here, just wanted to show you some of our outlooks for those important trade partners. So you can see the 2025 forecasted growth rate, and then this column here, we have the 2026 growth rates. So you can see that these are all positive numbers. So by the end of the year, a few of these, like Canada and Europe, will start to slow in growth, but they'll actually accelerate for a portion of the year. And overall, those are slightly better growth rates, certainly than 2025. And the slightly less mature, more younger economies of India and China are just going to keep growing in the coming years. So their cycles can be a little different from the other countries, but just they're generally growing. All right, so This, though, is supportive of oil demand and therefore also prices. So, globally, a better outlook for oil in 2026. The other factor that I wanted to mention here, this is another one of those kind of unknowns, is OPEC has been losing some of their share of the global market, whereas the US has generally been increasing their share. So it's really going to depend on how aggressively does OPEC try to claw back some share? Are they willing, how much are they able to tolerate some lower prices in order to kind of get a bigger chunk back? One potential limit on that is in this table, we have the OPEC countries ranked by their volume of production. And then there's also some IMF estimates on essentially what's their fiscal break even. So what oil price would they ideally have in order to maintain a balanced budget? So it doesn't mean they absolutely have to do this, but more of where they would probably prefer oil prices be in order to support their fiscal spending for their country. So to me, when I skim over this list, it looks like this could put a limit on how much they tolerate oil prices going lower. So they could try to be a little more aggressive on market share, but there's a potential kind of damper here that might stop them from really wanting kind of tanking oil prices. So let me just skim back up to the top here, kind of circling back to the good, the bad, the unknowns. We just talked about a lot of those unknowns. So essentially things like sanctions with Russia, the OPEC decisions, kind of some of the conflicts in the Middle East, how do those turn out? So those are a little more geopolitical. I consider those more unknowns for the forecast. And then in that kind of bad category there, oil prices are likely kind of around or below break even for a lot of new projects. So that's not a great thing. And also the higher input costs and borrowing costs, those are all factoring into, are new projects attractive or not? And kind of the equation for that is it looks like roughly, at least this first half of the year, probably going to be pretty conservative on that upstream investment. But the second half of the year start to see some improvement once prices are back around $70 per barrel. That would help. There's also the competition from alternative energy sources, and Saudi oil production is accelerating. So those are kind of the negative bucket. I want to leave you here more with the good bucket. So the demand for oil is going to improve in the coming year as both the US and a lot of our trade partners' economies are set to improve and grow in 2026. We're starting to see the trade policy, kind of that uncertainty is beginning to fade. So that's a good thing for kind of the uncertainty can also impact the CapEx decisions. Oil inventories are relatively low, so if we want to replenish those, we're going to need to produce more. And our exports, they have declined a little bit recently, but they have seen like pretty much exponential growth over the last decade. They've really picked up quite a bit, so the trade relationship is quite important. And then there's also, some slight regulatory improvements coming from the current administration as well. So definitely this market facing some headwinds, but there is some support there as well. So we do expect some gradual improvement for the upstream drilling and exploration. And then if you're exposed more to the extraction phase, should be growing, or like downstream of that, different, refineries or chemical production, things like that. Those are actually in a relatively better space. It's really the upstream drilling and exploration that has suffered recently, but we do expect that to be turning around here fairly soon. All right, taking up enough of your time here. If you have some further questions, certainly reach out to Tom and he can forward them on to me. The next webinar we have should be in early December, so coming up in a little over a month. So look forward to chatting with you all there.